Welcome to today's Explainer, where we're going to dive headfirst into a truly blockbuster earnings report from Morgan Stanley, and then we'll telescope out to look at their massive predictions for the future of AI. This isn't just about a single bank having a solid quarter. It's actually a fascinating look at the macro forces that are shaping our global economy, both right now and for years to come. By the time we wrap up, you'll see exactly how traditional finance and next-generation technology are basically colliding.
Okay, so here is our roadmap for today. We've got 4 key areas to cover. First, a record-breaking quarter. Second, the 10 trillion milestone. Third, the Circle downgrade. And finally, number 4, the AI superhighway. This agenda is going to give us a really complete picture of exactly where capital is flowing right now. We'll start with the hard numbers of today's market reality and then zoom out to a multi-trillion-dollar macroeconomic forecast.
All right, let's jump into Section 1, a record-breaking quarter. We're kicking things off with Morgan Stanley's Q2 performance, which CEO Ted Pick has flat out described as exceptional after they smashed analyst expectations across the board.
The sheer scale of their success here is just massive. Earnings per share hit $3.46, which blew way past the consensus of $2.89. And their revenue, it skyrocketed 27% to a record $21.35 billion. That is not just a slight beat, that's a massive statement about the strength of their integrated business model and their ability to execute consistently on a truly global scale.
So, what was the powerhouse behind this beat? Well, it was their Institutional Securities division, which saw a staggering 69% jump in equities trading revenue. Just think about that. That surge created a near $2 billion upside compared to what analysts were initially expecting. And this incredible performance wasn't isolated either. They saw broad-based client engagement across cash equities, derivatives, and prime brokerage, particularly showing some really notable strength over in the Asian markets.
But hey, it wasn't just the trading floor making moves. Investment banking completely roared back, with revenues climbing 58% to $2.4 billion. Advisory revenue also jumped 57%, and that was thanks to higher M&A activity across industrials, tech, and healthcare. And equity underwriting, that climbed 70% as the IPO market finally made a massive comeback. Their pipeline remains highly constructive, with global client dialogues expanding rapidly day by day.
Moving right along to Section 2, the 10 trillion milestone. Let's look at their second major business, wealth management, which delivered a record $8.9 billion in revenue and crossed a pretty historic threshold.
$10 trillion. Total client assets across wealth and investment management just surpassed that monumental mark. And it was fueled by a record $148 billion in net new assets. To put that into perspective, capturing that much fresh capital in a single quarter is a staggering achievement. It takes immense structural capacity to absorb that kind of inflow, and honestly, it just solidifies their position as an absolute titan in the global wealth management space.
Now you might be wondering, where exactly did that $148 billion come from? Well, over half of those new assets came from IPO-related flows through their workplace channel. This proves that their corporate relationships are just a massive engine for wealth acquisition. Think about it. When they take a company public on the investment banking side, the newly generated wealth flows right back into their wealth management ecosystem. It's a perfectly synergized loop that just keeps feeding itself.
And because of this record profitability, the board is raising the quarterly dividend by 15 cents to $1.15 per share. And they're reauthorizing a massive $20 billion multi-year share repurchase program. As Ted Pick pointed out, having this kind of financial strength gives them the ultimate flexibility. They can confidently invest heavily in future growth opportunities and infrastructure, while simultaneously pouring returns right back into the pockets of their shareholders. All right, let's pivot to Section 3, the Circle downgrade. Now, while the bank is clearly thriving in traditional finance, their research analysts are making some bold and, frankly, aggressive calls on the crypto front. In a really stark contrast to overall market sentiment, analyst James Fawcett just downgraded stablecoin issuer Circle to underweight, slashing their price target from $106 all the way down to $38. That is a massive adjustment. It signals a major shift in how traditional Wall Street analysts are evaluating the underlying fundamentals of top-tier crypto businesses. So, why the huge drop? The underlying reason for this downgrade really comes down to volume. They're projecting reduced USDC volumes. We're talking down 33% for 2027 and 44% for 2028. And they're citing major fundamental concerns as tokenized money market funds apply pressure. Essentially, a contraction in USDC circulation is squeezing Circle's reserve income, which forces the business toward a much lower margin transaction model.
It's a highly competitive space, and Morgan Stanley is ringing the alarm bell on Circle's core business fundamentals.
Which brings us to Section 4, the AI superhighway. Now let's pan all the way out to the macro theme of the year, where Morgan Stanley is actually advising clients to buy the dip after AI infrastructure stocks dropped 7% in July due to technical pressures.
Morgan Stanley sees that 7% drop as being driven by profit-taking and forced selling, not a weakness in the actual tech. What truly matters here is the staggering scale of impending capital expenditures. Get this, data center CapEx is projected to stair-step all the way up to $1.5 trillion by 2028. Going from $870 billion in 2026 to $1.5 trillion just 2 years later, that represents one of the most massive infrastructure build-outs in modern economic history.
Now, if you're worried about cheaper, more efficient models from China maybe curbing this massive spending, Morgan Stanley points to something called Jevons paradox. It explains why cheaper AI will actually drive up demand and accessibility. It's an economic principle stating that as technological progress increases the efficiency of using a resource, the overall demand for that resource actually increases. It sounds totally counterintuitive, right? But history proves it's true. When a technology becomes cheaper and easier to use, we don't spend less on it. We invent thousands of new ways to use it, and that skyrockets the overall demand across every single sector.
This accelerating demand is exactly why Stephen Bird, their global head of thematic research, calls this an intelligent superhighway that will provide significant net benefits to the global economy. Furthermore, they note that the median enterprise employee currently spends less than $11 a month on AI tokens. That means this superhighway has a massive runway for growth. If you think we're hitting a cap on AI spending, Morgan Stanley says think again. $11 a month is barely the on-ramp for what enterprise adoption is eventually going to look like.
Now, there is one major bottleneck for the superhighway, and it's power. Getting connected to the grid can take 5 to 7 years, and that's creating a massive shortfall between what's currently being built and what's actually needed. Right now, we have 30 gigawatts under construction, but we need 68. You can't just plug $1 trillion worth of new data centers into a wall socket. You have to build the wall, the wires, and the power plants first.
However, Morgan Stanley views this gridlock as a speed bump, not a brick wall. They believe alternative energy solutions are going to bridge that gap. Because the traditional grid takes years to permit, regulate, and build, the immediate future belongs to bridge solutions. We're talking about massive, immediate investments in commercial fuel cells, cutting-edge energy storage systems, and natural gas turbines that can power these massive data centers independently, while the broader national grid plays a long game of catch-up.
So, with Morgan Stanley firing on absolutely all cylinders today, and projecting literally trillions in AI infrastructure tomorrow, the question isn't whether this future is arriving, it's how you are going to navigate it. The capital is moving, and the infrastructure is being laid down as we speak. The intelligent superhighway is being built right in front of us, but are you positioned to ride it, or will you be stuck in traffic? Thank you so much for joining me for this explainer, and definitely keep these incredible numbers in mind as you watch the markets this week.